Alright, I welcome everyone to this video, and in this very video we are going to be talking on the topic institutional versus retail approach to price action. Institutional traders versus retail traders approach to price action. It is a well-known fact that one of the problems that retail traders encounter in the financial market trading is the market makers or institution, which tends to fluctuate or manipulate the market every time against the retail traders. So all the studies that individual trader like you and I usually undergo on this journey, it is all through all about studying, keep developing yourself, improving on your strategy, all is just to be able to decode institutional tactics or trap because these guys manipulate the market against us always. So knowing some of the tricks is going to help you and shape the way you approach the market, basically, right? So in the previous topic or at the beginning of this course, I took time, and this is still in module one. So I'm basically taking the introduction before we go deep into what we have to do. Some of these things are very important to remind ourselves. I studied all of them in the past, right? But often I have to carry out a research to remind myself of this, foundation, because you cannot trade the advanced strategy without knowing this, foundational aspect of the market or price action approach. So I have tried a bit, but this very course may be a little bit heavy for retail traders. I mean, sorry for new traders that just join financial market trading or analysis. But I've taken my time to make sure I break down everything to simpler terms. What is too difficult to understand, individual can undergo research to align, or you can go back to my catalog. I simply have other courses like the Introduction to Price Action, which is going to lay the foundation for a topic or course like this, basically. So we have to know that this is one of the most important topic, as long as understanding why the market moves the way it does and why most traders lose money while a few consistent win, right? So it is a well-known fact from the research that 90% of retail traders are not consistent in their profit making. I'm going to take time to show you why it is so and how to overcome and be listed among the 10 or 5% that are consistent. And I also want to state that being a consistent trader is a bit difficult for those that trade currency market and you are everyday trading 5/5. What do I mean by 5/5? Monday to Friday, you are trading every day, every time you're on chart. Staying consistent with your profit may be a little bit difficult if you're that kind of trader. So you have to shape your trading plan at the same time. So in this course, I'll take you guys through institutional tricks, traps, and how we can overcome some of these things. Though we cannot do it all, right? There's no retail traders that doesn't lose trade. It's just a matter of when, right? But we all strive to make sure at the end of the trading week, trading month, we come out with a profitable account that is going with the increase. So you have to know that in trading, success doesn't come from what you see, but from how you interpret what you see, right? Two traders can look at the same chart, one loses money, the other makes money. Typical example, this is a USD card, 1 hour time frame, right? Another trader somewhere is looking at this very chart as well. And five traders can analyze the chart. It is not all that is going to come out with a win or a perfect play out after forecast because we all see the market differently, right? It all depends on your own market approach. That is what is going to determine the outcome of your trading at the end of the trading day. And if I analyze this trade and some other trader analyze this trade, I may come out with a profitable trade, the other person lost, or it can be the other way around. That is simply because the understanding of price action, differ. Retail traders who make up the majority of market usually react to what they see on the surface, right? Institution, on the other hand, banks like the hedge funds, then pro firms, this mostly central bank, right? These guys act based on what happens behind the scene, mainly liquidity, order flow, strategic positioning. Once you understand these differences, your entire approach to market will change. Now, what do I mean by that statement? These guys act based on what is happening behind the scene. What does that tell you? They see what happened. You and I is trading from the comfort of our home. These guys are the ones that determine the market. They are the market forces. That is what that statement means. Everything that we're doing is just to make sure if we can align our position or trade with them. They are the market makers. They make decision, we follow. So the strategy, the learning, price action, and the risk trading, indicator trading is solved to make sure if we can follow along with them as they move the market. So in this very topic, I have took time with a lot of research and my observation and experience over the years. I've listed out some of the key points, how these guys, institutions react to market, how retail traders react, and how we can try to align ourselves with them. So the retail traders approach, right, is the number one point. Retail traders are just the small players, in the market. Our trades are too small to move price meaningful. Because of that, institutions rely on our activity to generate liquidity. They usually follow indicators, as retail traders. We follow indicators, basically trade signal blindly without understanding the market context. We react late to breakout and reversal. Oftentimes, when the move is lower, it's almost over. That is basically late entry into the market. So we cannot move market meaningfully. This is statement. I made a statement like that. We can't really move market meaningfully. What does that mean? You and I can be here opening a trade 0.50. Another trader is somewhere opening 0.10. Another trader somewhere trading $1 loss size. Another trader 0.20. Meanwhile, one institution like, let's say, a central bank of my country can walk in now and demand a volume, 50 million in volume of this currency pair right now. Who do you think that the market is going to obey? Excuse me. With these two, this is multiple people just playing with lower lot size and one person just working with this volume of lot size, right? To buy or sell this currency. Who are you going to obey if you were the business owner? Definitely is this person. So these are the people that make market move. They create everything that happen in the market. They move the market. They make the decision. We just try to, kind of beg with them, read, study, understand how you can move along with them or jump into the market a little bit when they might have moved, right? So that's why I added a kind of late entry while I was taking that explanation, right? So the next point is how institution specifically approach the market. Don't forget our first point, I outlined how you and I approach the market. So let's see how institution approach the market, which is point two. Excuse me. Institutional traders understand that price action is simply a reflection of liquidity, right? When I mean liquidity for new traders in our midst, you have to know every provision in life have a terms which they use to approach things that may not be common to a layman. So when I say liquidity, it simply means money, right? When I mean liquidity, it simply means money, basically. So you don't have to be confused. So institution, basically, these guys doesn't chase price, right? Instead, they create it. And these are some of the key points about these guys, about this institution, how they approach the market. They build position slowly within accumulation, that is buying, distribution, selling. And in one of the first topic, understanding price movement, I talk about the three market phases. I'm not going to repeat, but it was distribution, accumulation, and then market expansion. In this case, institution build position within accumulation by, that means accumulation happen on the support or a demand zone situation. Price was moving downward, then you start seeing a range market or a consolidation. The next thing, breakout, start buying. While distribution in the other hand happen on a resistance zone. Basically, price was coming, all of a sudden it start ranging. So this change in direction, the next thing you see a breakout of the zone. So that is basically what that statement means. So my own teaching method, those that are familiar knows. I take a point, then I do illustration. We all see how these things work before we now move to carry out a real-time analysis and setup, which I'm going to post the result as well. So these guys manipulate liquidity by triggering retail traders stop loss, right? They trigger liquidity. Let me expand this so we can have a clear picture of what I want to do. What do I mean by triggering liquidity? This is our resistance zone. This is our support zone, right? And we all know that retail traders likely to sell at the resistance zone while buying at the support zone, right? These guys understand how we think. They understand how we act. They know our next action. That's why they're able to play with our emotions, right? We know that once the price moves into this resistance zone, we are going to start selling. So they trigger liquidity situation, they throw a stop loss hunting. So if we retail traders are taking entry at this resistance zone, you know that our stop loss is going to be definitely above this zone, right? So this is liquidity. In this case, support. We are looking to buy, take entry within the zone. Our stop loss is going to be below the zone. And you can see what happened next. This liquidity, they clear us out of the market. So by the time you see this, before the main movement take place, they already wiped 90% of retail traders out of the action. So the only 10% or 5% left that actually knows what they're doing because they recognize that tricks are the ones that will join forces with them to move the price. So that's basically, excuse me, what that statement means. You have to take note of all these things. It's going to help. I just feel it is important for me to share this idea or observation. So the place trade at key demand supply level where risk is lower, right? Let's go to illustrate that as well. So institution doesn't trade like us. A retail trader can see a pullback and jump into the trade at any point, even mid-market. Institution doesn't trade that way. They place that trade at key support level or a resistance. And I'm going to illustrate that. Okay, let me do illustration here, right? This is our resistance level. In this case, let's take this scenario that took place here. Entering trade at this point, sell. If you take the entry at this point, definitely our stop loss is going to be a little bit above this zone, right? So move this to this other point. This is our stop loss, this is our reward. And entering trade at this point, I'm doing illustration. That is almost mid-market. After how many sell candle? 1, 2, 3, 4. After 4 strong sell candle, you now decide to take entry. Where are you going to place your stop loss? Your stop loss definitely must be above this zone as well for you to be safe in case of any strange move in the market. So you can see the differences. This is a lower risk trade and this is a very high risk trade because of the entry. So these institutions know where to position their orders. They execute their orders at key supply and demand zone. Unlike retail traders can move into the market and take entry at any time, depending on the time frame that they're using, and that exposes us to more risks. Manage position strategically to maximize reward with minimal exposure, similar to what I just illustrated. So that decisions are based on order flow, volume depth, market imbalance, not on indicators. So volume, what do I mean by volume? Once they gather enough, like I say, an institution can come into the market, they want to execute a certain currency or buy a certain currency, $80 million in volume, right? That is going to cause a very strong movement, depend less in this case, it was a sell. This, can you see the candles? This sell candle is not similar to this, but all of them use 1 hour to form. That should tell you this movement at this point might have caused by retail traders because we don't have the volume to cause this kind of dynamic, swift movement in the market, right? So it is only institution that can do this. This movement that you see on this chart is institution. Retail traders, cannot do this at all. So that is what that statement means. So you have to notice when this volume increase all of a sudden, you should know that these guys are ready to come into the market. Then on the other point, after they execute this, they create imbalance, then retail traders might move the market to, let me change that to black, please. So this imbalance from this level, the price broke out of the market structure. You know, this was a full structure, double top, price broke out of the neckline. So from this point to this level, which the price is going to locate, and if you check backward or backtest, you're going to realize that there is a key support zone at this point. That's why the price came to this level, cannot move again, it bounced. So this imbalance left behind is going to form a correction. So the price will certainly return to fill this imbalance. Then institution is going to take another order to continue to execute that order at this point, downward still. So in some cases, I'll show you guys how retail traders, we can meet them at this point, join forces with them to push the market downward. All these are strategy applicable to the smart money concept. And in this course, I'm going to discuss it at the situation where demand turn to a supply, right? This is demand and this is a supply, definitely. So we are going to see some of these things in practice as we progress. So that's basically how these guys approach the market, not like us. So how institutions exploit retail traders, right? Like I said, our fight daily is how to overcome these guys because they influence or manipulate the market against us. And they know that retail traders love breakout and obvious support or resistance zone. They push price slightly above resistance or below support, triggering retail entries and stop loss, and then reverse the market. This tactic is called liquidity grab or stop loss hunting. I explained that earlier in the video as well. So a way to collect orders before the real move, begins. So if you learn to identify this move, it's going to help you. So this guy used us to collect orders. I'm sure some of us might have read that foreign exchange market made at least $1 to $2 trillion every blessed day. Where do you think they get all this money from? It's from retail traders as well. So having known that we are going to wait at this level, resistance or support to take an order. So they will send a liquidity grabs or stop loss hunting or liquidity sweep to clear our orders before they release the main movement for the day. What does that tell you? This is our support zone. This is our resistance, and you see a kind of ranging market at this point. Say the price was coming downward, then start seeing a consolidation. Watch out if you see a stop loss hunting at this point, at this part of the zone. We all know what I mean by stop loss hunting. They throw a price candle, long candle at the end of the day before the interval of the time frame. You see the candle close, still come down close within this zone, leaving these other parts to turn to a wick. So if liquidity grabs happen at this direction, your expectation for the breakout should be downward. If it happen in this other side, then your expectation and watch out for breakout should be this way. So basically, this is more of psychology than normal analysis, right? These are tricks that I've learned over the years of this price or chart monitoring. So this is how these guys exploit us. So we might have taken order at this point. They look at, they throw this out and clear a lot of orders at this point, a lot of retail traders stop loss, then price. And once this happen, take note, once this happen, just know that a breakout is going to happen anytime soon, right? So pay attention to that, follow up this thing, research on it. It's going to help. But do some own observation. We're going to put this into trading. So bridging the gap, this is basically like my observation on how to overcome some of this. To transition from retail to institutional thinking, retail traders must focus on structure and liquidity, not indicator. You have to pay attention to market structure. There's one thing I always say. This is what you always see in the market, always, irrespective of the time frame. That is price impulse, right? Pullback or a correction. Second, price impulse wave. Excuse me, irrespective of the time frame, this is what the market always does. This is institution moving the market Then this is bearish correction in the case of a downtrend, and this is second impulse wave. Let me write that because this is important. Impulse price, impulse wave. So I'll use I, because that is the first impulse wave. Then we have a pullback. Then in this case scenario of a downtrend, I can decide to call it bearish correction. Bearish correction, that's this movement. A pullback or bearish correction. Then price impulse wave second, and the structure complete. So once the market has done this, you have to be careful of what is going to happen next, because you can't really tell if the order is going to continue coming back to fill this imbalance and continue like that. So this is basically the pattern or the structure you should look out for. It is everywhere in the market, irrespective of how you want to look at it. It's just ability for you to train your eyes to see these things clearly. This is what the market does often. So pay attention, analyze the structure. It's going to give you a clear market view than indicator. See, it's just eye training. What is this? This distribution, price distribution at this point, a kind of consolidation. This is price accumulation at this point, right? Look at the breakout. So knowing the structures and expectation is going to help you. This is what I just said. If the stop loss something happen on the downside, expect the breakout upward. Look at the volume that leads to the breakout. This is how you know that the breakout is going to take place. So look at the volume. The candle is very low. The stop loss hunting was true on the downside, then the price break on the other end. So thinking like that, identifying accumulation and distribution areas before breakout, I just illustrated. Then enter a discount for buy and premium for sell relative to structure. Observe order flow confirmation from price movement. So by adopting this mindset, you will see how your trading is going to improve basically over time. Study the institution is going to help you interpret the market clearly. So by summary, retail traders, their institutions plan. I told you they own the market, they control the market, they plan the market. We retail traders only react to it. Institutions create liquidity traps to fill large orders. What I just explained. The key to success is to think like them, act at zone of imbalance, not at emotional extreme. So once you align your mindset with these guys, your trading is going to improve over time. It will take few real-time setup, which I'm going to trade on my live account, then I share results as well as we progress in this course. So that's basically what we need to know concerning retail and institutional traders market approach. That takes us to the end of this video. See you guys in the next topic. Thank you.